Hey guys, this is June Collier, and welcome to Stock Splits 101. Now, in this training, we will discuss stock splits, the different types, why they occur, and the effects they have on the price of the stock. The goal of this training is to teach you what stock splits are, how they work, and why companies use them. So let's talk about what is a stock split. Let's start off by discussing what a stock split is. A stock split is a decision made by a company's board of directors who decide to increase the number of shares that are outstanding by issuing more shares to the current shareholders. Now, this does not mean that if you're a current shareholder that you're going to make more money because more shares are being issued to you. In fact, as a shareholder, you will have more shares, but the value of your total portfolio will remain the same. Companies do stock splits when they feel that the price of the stock has gone so high that it's not viewed as affordable to most investors. They will split the stock to get more people interested in owning and trading the stock. Let's talk about market capitalization because this is going to explain it a little bit clearer. Market capitalization is the overall value of the company. You get market cap by multiplying the number of shares of a company, and you multiply that by the current stock price. So, for example, if a company had 1 million shares and each share was worth $20, the market capitalization of that company would be $20 million. Now, when the company does a 2-for-1 stock split, it now has 2 million shares. The price per share also splits from $20 to $10. So you still have a market cap of 20 million, even though the number of shares have doubled. You now have 2 million shares, but the share price is now $10 instead of $20. You still have the same 20 million market cap. All right. So let's get some examples. Let's look at an example. If Apple was trading at $400 per share and then announced a 4-for-1 stock split, that would mean for every 1 share you have, you would now have 4 shares once the split happens. So if you had 25 shares, you would now have 100 shares. But the price of the shares would adjust accordingly. If the price per share was $400 before the stock split, it would now be worth $100 per share after the 4-for-1 stock split. Hopefully, more investors will be interested in the $100 price and buy the stock, which would drive the price up and increase the overall market capitalization. The easiest way that I found to explain stock splits is to use the example of a dollar bill and 4 quarters. If you had $1 bill and I stated that I was going to do a 4-for-1 split on your dollar bill, that would simply mean I would replace your dollar bill with 4 quarters. You didn't lose the price value, but you did gain 4 items versus 1 item. Now, there are a few stocks that never do stock splits. One example of such stock is Berkshire Hathaway Class A stock. At the time of this recording, 1 share of Berkshire Hathaway Class A was worth $291,510 per share. So how many investors do you think own Berkshire Hathaway Class A stock? Probably very few in comparison to investors who own other stocks. Because mentally, when you look at the price per share, it just seems to be outside of the affordability range. Now, even Warren Buffett understands the psychological effect that this price can have on many investors. So they created a Berkshire Hathaway Class B stock, and that sells for $195 per share at the time of this video recording. More investors will hold the Class B share of this stock versus the Class A share. including myself. I hold Berkshire Hathaway Class B. Now, stock splits keep share prices affordable for the average investor. Now, up to this point, we have talked about a company's board of directors deciding to increase the number of shares of a stock, which makes the stock more affordable to investors. This is known as a stock split. But there's also a reverse stock split, which is the exact opposite. This is when the board of directors decide to decrease the number of shares that are held by current shareholders. So, if a company does a 1-for-6 reverse stock split, they are essentially giving you 1 share of stock for every 6 shares that you currently own. Companies will often do this if the share price has dropped so low that the stock is risked at becoming a penny stock and potentially being delisted from the major stock exchanges. Let's imagine that you had 100 pennies, and I came along and I did a 1-for-100 reverse split. I would take your 100 pennies and in return give you $1. The value is the same, but the appearance of the value has changed. More people would be interested in a stock that was worth $1 than a stock that was worth 1 penny. In addition, you can keep a stock from getting delisted and placed on the over-the-counter boards. We've talked about that earlier. Let's look at a well-known company that did a reverse stock split recently. Let's take a look at Office Depot. Before the reverse stock split, the price per share had dropped down to $2.35. After the decision to do a 1-for-10 stock split, the new price of the stock was valued at $23.50 per share. Office Depot went from 526 million outstanding shares of stock to 5.26 million outstanding shares of stock. Again, the market cap stayed the same. The only thing that changed was the number of outstanding shares and the price per share. I now hope that you have a clear understanding of stock splits and reverse stock splits, how they work, and why they're implemented.